and introduce on the show a very special guest, Mr. Sunil Rohokale, the Managing Director and CEO of the ASK Group. Mr. Rohokale, thank you so much for taking out time today on The Money Show. So to start with, while we're very familiar with the concept of equities, debt, FD, fixed income, so on and so forth, there are two products that are relatively newer in India. And I'm not talking about Bitcoin, because that seems to be the only thing on everyone's lips nowadays. I'm talking about REITs and InvITs. To start with, if you had to, explain a layman what these two products are, how would you explain it to them?
Yeah, thank you, Mubina, for inviting me for the show. These two instruments are really new to the country, new to the investors fraternity. And these are basically a product which are actually part of the fixed income kind of a basket, but it actually has got a returns character, which is little better than debt kind of a instrument. These are typically a trust which actually holds real assets, which could be real estate assets, which can be commercial buildings, retail malls, it could be data centers, it could be warehousing, it could be rental housing, it could be hotels, it could be industrial parks. So that's a real estate trust, underlying assets. And if you look at the InvITs, these are typically, again, the assets like road assets, power asset, gas assets, and so on and so forth. So these are physical assets which has got an annuity kind of an income which is received from these assets to the owner of this asset. And these assets are then pulled into something called as a real estate investment trust or InvIT, and they get differentiated and they get then listed. So whatever is the earned from these assets through this investment trust then is being passed on to the unit holders. And that's the net, the meaning of the REITs and InvITs as far as the instruments are concerned.
So basically, you'd get two kinds of returns. One is the annuity or dividend, as we call, which will be distributed to the holders every year. And the second, of course, would also be capital appreciation, because you will sell these units at the end of whenever you want to sell them. Is that correct, to get the sum of it?
Absolutely. I think the beauty of these units is that the underlying is the real asset. So it has got a lot of security assets, securities attached to that instrument, right, which is basically the REIT or InvIT. The REIT or InvIT regularly distributes the income earned by that asset and passed on to the unit holders by way of either distribution of income or distribution of dividend. These units do also have a propensity to have a better appreciation in the long run by simply because in case of REITs, these assets are typically very good A grade office buildings which has got rental appreciation in the future, or the rental appreciation of the old tenants who are supposed to be paying more rent now or in the future would get translated into an appreciation which is like an equity-like appreciation. Because when you own the unit of the REIT or an InvIT, in a way, willy-nilly, you become the part owner of that asset. Unlike the fixed income, where we are not an owner, you are actually getting only returns. In case of REITs, you are actually becoming a small owner. And when you become a small owner, you get the dividend or an income on a regular basis. At the same time, whenever there is an appreciation of the annuity of this particular asset, you also being the owner of the asset is passed on to you. And that is actually getting captured into the equity kicker part. And hence, REIT and InvIT actually have a superiority over the pure fixed income product. Obviously, it has got little inferiority as far as the equity returns are concerned. But in terms of safety, they are no less than the best secured bonds.
Okay, so in a way, it's also a great way, firstly, for those who, of course, can't shell out those big sums, forget for, road and all of that, but maybe for realty as well. And also, sometimes you don't get that regular income when you own a real estate. I mean, of course, rental is one way, but the yields are extremely low. Here, you'd probably get a better yield as well, I reckon, sir. So, we've understood this bit, but it's important to give our viewers a holistic picture. So if we have to talk about the risks associated with these instruments, and also whether these instruments are suitable for all kinds of investors, sir.
Okay, so I think that's a very vital question. In fixed income, unless and until one understands the risk associated with the instrument, I think it is futile to invest. And I think there are certain risks which probably are unearthing now. We have seen what happened in fixed income as far as credit risk funds are concerned, and the recent discussion what we talked about the perpetual bonds or tier 1 bonds or tier 2 bonds, and what happened to the banks perpetual bonds and so on and so forth. So I think it is important to understand what are the risks associated in this asset. These assets invest into say, for example, these assets invest into a commercial building, and the commercial building has got a good tenants, and the tenants is paying on a monthly basis the rental for this particular REIT. Now, first risk is the vacancy risk. If the tenants vacate the particular property, that would impact the earning of this particular trust, and that means it will be less money in the hands of the unit holder. That's the first part. Now, the second part is that if there is the situation like pandemic happened, where there could be possibility that some of the untenanted office buildings, offices would take longer time to rent, right? So that's the second part. And third part is that if there is a volatility of rentals because of economic downturn, and people would like to renegotiate the rental with the landowner, which is the trust in this particular case. So in all this situation, you could have a vacancy risk by virtue of tenancy, by virtue of postponement of the revival of economy. These are the fundamental risks associated with this particular instrument. But at the same time, there is a counter-cyclical, there is an opportunity for making the good for it. Because in case of, we are taking a risk of vacancy, but at the same time, the price appreciation happens, the rental appreciation happens, and which is all the time continuous process, because at no point of time, all the tenants pay the same rental. Old tenants pay much lower, the current rental pay the market price, and the future tenants are going to pay the future rental. And every 3 years, typically a 15% escalation in the rental is what the historical averages we have seen across, which is typically a rental, the inflationary expectations which are inbuilt into the rentals part. And hence, if you are expecting that 15% is going to be escalation in every 3 years' time, and they are going to be very well balanced between the old tenants and the new tenants and the revision of the rentals of the tenants, then there is a possibility of the risk what you take on a downward side, it is getting compensated far superiorly on a upward side as well. As far as these instruments are concerned, this instrument is not very retailish per nature. So it is not the mutual fund where one really gets a chance to invest at 500 rupees. These are not also very sophisticated investor instrument, which is like AI, where you really need to put 1 crore plus. But these instruments are actually basically focusing.
Mr. Rohokale, I'll just have to interrupt you over there because we are a little short on time, but point taken, just to, sort of get a check on InvITs and REITs as a whole. Thank you so much.